Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today, ask yourself, are you looking to add some new dividend stocks to your portfolio or just sort of research some new ones? Well, you've came to the right place. We're going to be covering 5 of the best dividend stocks going ex-dividend next week, November 19th through the 23rd, 2018. So if you are brand new to my channel, I do make stock market, personal finance, real estate investment videos every single week. So consider subscribing for future videos. And if you are subscribed, hit that notification bell to be notified every time I release new content. So we have 5 stocks being discussed this week. Our first one here, ticker symbol HCSG. This is the Healthcare Services Group. They're within the services and healthcare sector. Next, we have ticker symbol HSY. This is the Hershey's Company. They're in the consumer goods sector, very popular there. Ticker symbol RHI. This is the Robert Half International. They're within the services sector. Next, we have the SBSI. This is the Southside Bank shares. I believe we've talked about them in the past. They're in the financial sector. And then next we have ticker symbol SNA. This is the Snap-on Industrial. It's an industrial goods sector. So not Snap, the iPhone or the Android app, the application, social media application, completely different there. So all of these stocks were screened for initially, all starting yields over 1.5% or higher, meaning that if you put $100 into these, you're going to get at least $1.50 back per the entire year for every share that you hold or more. All of these stocks do have rising revenue, net income, free cash flow, positive in the positive direction over the last 5 and 10 years, so their financials are here in order. Their forward price to earnings are expected to decline. Their earnings per share is expected to grow into 2019. Sometimes they take on more debt, which does cause their PE ratio to rise, but their earnings are increasing, but their PE ratio seems to also increase. That's because they've taken on more debt. And here, in all of these, their PE ratios are expected to decline with earnings going into the future, meaning that they're becoming more profitable. So those are some of our screening factors that we take into consideration here. We will be covering the dividend stocks, the ex-dividend dates, price comparison to the yield, PE comparison to the industry, the sector, their industries, the S&P 500 as a whole, the payout ratio of all of them, the dividend history, and a few other items as well. So if you haven't started your investment journey, I highly suggest checking out M1 Finance. If you invest currently in the month of November, $100 into your individual account, that's that taxable account, you get a free $20 when you go through referral is in the description below and also in the comment section. But you don't have to invest $100 into the individual account. I still highly suggest all individuals start off with a Roth IRA. You do have to have $500 in there, but that's going to give you that tax sheltered account. When you're 15 and a half, all your capital gains, your interest, your dividends will be 100% tax free if you buy and hold within that account for the long term. I've created 2 free applications here on the Google Play Store. One's a simple dividend calculator. The other is a simple retirement calculator. I recently did an update on that simple retirement calculator. I'm going to be coming out with a few more updates here in the future, but these are out. They're active. My next big thing is working on my website to, put more content on it. That way, it's there. There's information there for personal finance. There's information there for stock market investing, real estate investing, and just knowing all your different investment vehicles that are out there and available to you. So all of these stocks are ordered here by ex-dividend dates. They may have a 1, 2, 3, or 4, but that is just a number that they're coming up by ex-dividend date from November 19th through the 23rd, 2018. So let's go ahead and start here. Number 1, we have ticker symbol SNA. This is the Snap-on. The company is a leading global innovator, manufacturer, and marketer of tools, diagnostic equipment, software, and services solutions for professional users. Their ex-dividend is next Monday, the 19th of November. You'd have to buy this one on Friday or prior. Hold it until the ex-dividend of Monday, the 19th, and then you would receive that payout on the 10th of December. Here, I always like to show their 10-year graph. So here, very easy to do their year-by-year increase. So you take a look at their price, 374.4. You divide that by 10. Your average increase here is on average 37.4% over the last 10 years. But you can see as of here, see that last bit of 2015, they have been just trending sideways here, going up and down, up and down. So this is pretty consistent. If you buy at these dips, the stock may recover to these peaks. You sell at the peaks, you wait for those dips, you buy at the dips, you sell at the peaks. So this could be a buying the dip opportunity. This one has been trending sideways, so it could be consolidating here and moving either a hard up or a hard down. You know, whichever there, it can go either way. So here in the red is their free cash flow at 34% on average per year. In the green, 16.8% on net income per year on average. And in the orange, we have their revenue at 4.55% on average per year. Very steady revenue increase, beating inflation there, whereas all their other numbers here, their free cash flow, their net income are up very nicely there. Here I like to show their 1 year graph just to kind of show off what sort of movement they have made here over the year. They are currently paying out 95 cents per share. They are currently trading at $158.93. You can see a huge waterfall here, during the month of October. So these waterfall movements, those are good buying opportunities. If you see a waterfall, that could be a buy the dip opportunity. You can see here that it did fall below 150. It got bought right back up. It is now trading at $158. It is still trading below that 200-day moving average of 161.69. The current dividend yield is currently 2.39. You can see that this is showing 2.06. They just recently announced a dividend increase from here around 82 cents per share to now 95 cents per share. This will be their 9th year. They've been paying out dividends and growing their dividend for the past 8 years. Here, this will actually bump them up into their 9th year, I believe. PE ratio currently sitting at a 14.4. Forward PE is at a 13.46. Current price to book ratio is 2.82. Price to sales is 2.23. So, taking a look at the graph above, the current chart, when charted, does show the current stock does have a price underneath that yield, which may indicate it could be undervalued at that time. It's also trading below that 200-day moving average. The stock is trading below the industry average of 19.4. It is also trading below that S&P 500 PE average of 22.27 currently. It is sitting below the 60% payout ratio that I like to believe, it's healthy right around that 50-60% payout ratio. This one's trading at a payout ratio of 32.2%. And it's had dividend growth for the past 8 years. Now, in 2010, they did freeze their dividend between 2007 and 2010. They were paying out there during that time. The recession hit. They froze that dividend in place, continued to pay it during those, that recessional period, and then 2010, they begin to raise it at an increase of 22% over the last 10 and 5 years. I did an average there, so it's been an average of 22% dividend increase over the last 8 years, which is very, very healthy there. Healthy-ish. Let's see here. Price to book, we've already covered that. So price to book 2.82, which is below that 3.0 value where asset-based companies would be considered a deal. Price to sales 2.23, which is also below 3.0 where sales and service-based companies would be considered a deal. So this one sort of hits the nail on the head. It passes all, it's trading below the industrial average, S&P 500 average. The price to book, price to sales are also looking very healthy. PE ratio very healthy. Trading below that 200-day moving average. Very nice, steady increasing there in the dividend. This one could be considered a dividend growth DGI, dividend growth investment. Yep. So moving on here, number 2, we have ticker symbol SBSI. This is the Southside Bank shares. They provide financial services to individuals, businesses, municipal entities, and nonprofit organizations. Their ex-dividend is Tuesday, the 20th of November. So you'd have to buy this one on Monday, hold it until Tuesday, the ex-dividend date, and then you would receive that dividend payout on the 6th of December. Here, again, 10-year chart, taking a look here, red is their free cash flow up 35% on average per year. In the blue, we have their price up 12% on average per year, keeping up or beating the S&P 500 here over the last 10 years. I believe the S&P 500 is right around that 10-13% right now on average over the last 10. Here we have in the green net income up 11.8%, and in the orange, we have their free cash flow up 7.88%. So everything there, very solid numbers there here at Southside Bank shares. You can tell that this is a financial. This is in that financial sector. And if we move down here, how long has this company grown their dividends? For the past 20 years. So when you see everyone's like, oh, don't invest in these financials, there's some financials out there that have actually continued to raise their dividend through these recessional periods. Here, well, this is showing a bit of a dip back here, but this is because of the special payout. This company likes to do special payouts. They're paying out 2 cents per share in this upcoming dividend ex-dividend and dividend payout. So this stock is currently paying out 32 cents per share. They're currently trading at $32.78, putting them below their 200-day moving average of $34.53. Their current dividend yield is not 3.54, it's actually 3.66. With this increase, they recently announced an increase here from around 30 cents per share to now 32 cents per share. They have an average increase there of 9.95%. Pretty healthy there. I like anything over 7% myself. PE ratio at 16.98. Forward PE 14.4. Price to let's see, this is price to sales at 5.4, and price to book, all those financials, I like to see them trading at a 1.3 to 1.7. This one's right at 1.5, which is very healthy. So when charted, it does show the current stock does have a price underneath the yield, which may indicate it could be undervalued at this time. The stock is trading slightly above the industry average of 13.4. This PE ratio here that this is given, this could be slightly off due to their earnings. I believe their earnings came in a little stronger than average and actually puts them right around that 13.6. I'm not 100% sure. I'd have to look that up specifically, but this information is just pulled from Y charts here. Forward PE 14.4, which is still slightly above the industry average. So price to sales 5.4, price to book 1.5. So this one is trading below that payout ratio of 60%. It's trading at a 52.9. and has had dividend growth for the past 20 years, on average up 9.95% over the last 5-10 years since 1998. So through the 2000 recession, that was mainly the tech stocks that fumbled, but 2007 through 2013, that hit financials very hard. This company continued to pay out, grow their dividend for the past 20 years since 1998. So here, current dividend yield around 3.66. They pay out $1.20 per share for the entire year. They do have a special payout coming out with this ex-dividend, and the payout is on the same date. So ex-dividend, if you hold it on the ex-dividend date, you're going to receive both the regular payout of 32 cents per share, and you're going to get an additional 2 cents there per share. And we've already covered here the rest of that information. Moving on here. Number 3, we have ticker symbol HSY. This is the Hershey's company. They engage in the manufacturing, marketing, selling, and distributing various chocolate and confectionery products, pantry items, and gum and mint refreshment products worldwide. Their ex-dividend date is on the 20th of November, which is next Tuesday. Again, you'd have to buy this one on Monday or prior, hold it until the ex-dividend date of Tuesday, and then you would receive that dividend payout on the 14th of December. Here, taking a look at their 10-year chart, starting in the red here, cash flow up 39% over the year on average. In the green, net income up 22.8% on average per year. In the blue, their price has increased an average of 20.4% on average per year. You can see here that it's been consolidating. It did a very fast right up here between 2008 and 2014, and has been for the most part trading sideways here. In the orange here, we have their revenue up 5% on average per year. So very solid company there. Chocolate's not going to be going anywhere. All of their products, they're consumer goods there. So taking a look here at their 1-year chart, they currently pay out 72 cents per share. You can see they just announced a dividend hike not too long ago. This one's actually pretty right on it, 2.48, 2.66, depending on the price of the day. So they pay out 72 and an eighth of a share there, or eighth of a cent there per payout per share each quarter. They're currently priced at $108.67. Looks like they were trading below that 200-day moving average for quite a while, a couple months there in the past, but they just recently broke above that 200-day average, which could be an important key mark there. So maybe some investors are seeing that they broke above that 200-day moving average, jumped into it, and it has climbed higher there. So dividend yield 2.66, in between 2.66, 2.48. Price to PE ratio, price to earnings is 22.5. Forward PE 20.18. Price to book very high at an 18.46. But they're more of a sales driven company with all their products. So price to sales is 2.96. So when charted, it does show the current stock does have a price over yield, which may indicate it could be overvalued at this time. So here we can see their price is 108, whereas their yield would either sit between 148 and 266, which would put their price slightly above average for the year, making them either semi-valued or semi-overvalued. The opinion's up to you guys. The stock is also above the industry average. So here it's trading at a 22.5, industry average of 20.3, and it is also trading above the S&P 500 PE average currently of 22.27. The payout ratio is at 53.9, which is below the 60% payout ratio I like to see. Dividend growth for the past 8 years. So back in 2007, they froze their dividend in place until 2010. As of 2010, they have increased their dividend payout by roughly 12% on average per year. Their price to book is at an 18.46, which is above that 3.0 value where asset-based companies would be considered a deal. This is more of a sales-driven company, so price to sales here is 2.96, which is below that 3.0 value where sales and service-based companies would be considered a deal. So here, PE 22.5, industry 20.3, S&P 22.27, dividend yield 2.66, and so on. So we've already covered most of this information here that we've already kind of hit the hammer on the head. So moving on here. Number 3, we have ticker symbol RHI. This is the Robert Half. They provide staffing and risk consulting services in North America, South America, Europe, Asia, and Australia. It operates through 3 segments: temporary and consultant staffing, permanent placement staffing, and risk consulting and international audit services. So their ex-dividend is on Wednesday, the 21st of November. You'd have to buy this one on Tuesday. Hold it until Wednesday, the ex-dividend date, and then you would receive that payout on the 14th of December. Here, their price is up very high, up 24.9% on average over the last 10 years. You can see there was a bit of a dip here between 2015. They came down very hard, bottomed out here, midpoint 2016 before climbing out, peaking out here, what looks like maybe April of 2018 before coming back down. Here in the green, we have their net income up 4.7% on average per year. In the red, free cash flow up 2.7% on average per year. And in the orange, 2.3% on average per year. So their revenue, net income, and free cash flow, their numbers really aren't that amazing per year on average on average. That could be why, they dipped here during the recessional period. They came up. They seem to have bottomed out and kind of flattened out at this period and been trending sideways here with their financials. That could be due to why their price had came down. Maybe they missed some sort of, earnings during this time frame, had moved up, down, maybe came out with some nice earnings during this downturn. They are beginning to turn around here. 2018, you can see that they are beginning to turn around. This could have been what drove this price up high, but it shot up way too high in comparison to where it should have been and came down because of that. So here we're taking a look here now at their 1-year chart. Let's go ahead and just move this here manually here. So, taking a look at their 1-year chart, they currently pay out 28 cents per share. They are currently trading below their 200-day moving average of 65.28. They are at $62.78. That puts their yield a little higher at 1.72, 1.78, depending on that price and the day. Their current PE is at a 20.93, forward PE 17.71, price to sales 6.8. Well, this was a Robert Half. Robert Half was a services sector. Okay, so they're not financial. They're more in that services. They do consulting and such. Okay, I thought it was more of a financial there. So here, price to sales 1.35. So taking a look here now, we have right there. When charted, does show the current stock does have a price below the current yield right now, which could mean it is undervalued at this time. The stock is trading below the industry average of 22.8. Remember, it's at a 20.93, so it is below both the industry average of 22.8 and the S&P 500 of 22.27. It is sitting below 60% payout ratio at 32.5. Dividend growth for the past 14 years since 2004. 2004 is actually when they began to pay out a dividend, so I didn't ever see a dividend cut. I didn't see any sort of dividend halting of any sorts or freezes. This one has just started paying out dividends in 2004 and since then has continued to raise dividends year over year over year at an average for the last 5 and 10 years of 15.22% for the last 14 years. Price to book here, 6.81, which is above that 3.0 value, where asset-based companies would be considered a deal. But this is a service-based company, so price to sales here for that services is 1.35, which is below that 3.0 value, where sales and service-based companies would be considered a deal. The stock here, we've already covered much of this, so current dividend yield 1.78. They pay out $1.12 per share for the entire year, or 28 cents per share each quarter per share. Their payout ratio, 32.5. 14 years of dividend growth since 2004 at an average increase of 15.22% there. So pretty solid company there. Kind of interesting. They do services, so they could, they're basically, they're temp service They hire in people, and they probably get paid for their services. I know that's how some of these companies here in our area work. So last, we have ticker symbol HCSG. This is a healthcare services group. They provide housekeeping, laundry, linen, facility maintenance, and food services to nursing homes, retirement complexes, and other areas in the United States and Canada. Their ex-dividend is on the 21st of November. You would have to buy this one on Tuesday or prior to be holding it on the ex-dividend date of Wednesday the 21st. And then you would get paid out that dividend on the 28th of December. Here, taking a look at their 10-year charts, you can see in the red here that their free cash flow has been up and down, but on average, it does increase an average of 38.9% on average per year. In the blue, their price is up 35.4% on average for the last 10 years. For the most part, they've trended sideways as of 2016, maybe gained some momentum here. I'm not sure how much a percentage here between 2016 and currently, but a little bit there. In the orange, we have their revenue up 23% on average per year. And in the green, we have their net income up 17.1% on average per year. I do talk a little bit fast. I'm sorry. I'm just trying to get through these videos as quickly as I can. So I don't want to speed through it, but at the same time, otherwise these videos become 30-minute, 40-minute long videos. So here we're taking a look at their 1-year graph. Let's go ahead and bump it up a little bit. Oh, there we are. Okay, 1-year graph. They currently pay out 19.5 cents there per share each quarter. They're currently priced at $43.13, just moving slightly above that 200-day moving average of $42.19. Their current PE or their current yield is 1.81, 1.78, depending on the price on the day. Their current PE is at a high 44.42. Their forward PE, you can see it drops dramatically there from to 29.76. Price to book 7.58. Price to sales 1.59. Services company here. So when charted, it does show the current stock does have a price under the yield, which may indicate it could be undervalued at this time. The stock is trading above the industry average. So here industry is at 44.42. It's at 24.8 as far as the industry, and above the S&P 500 of 22.27. It is sitting below the 60% payout ratio. It sits at a 52.7% payout ratio. Has grown their dividend for the past 10 years since 2008. So back in 2008, they did a stock split. They split it up 3 for 2, and for a quarter, for a payout session, they decreased it there because they did a stock split. They were testing the waters. You know what? They decreased that dividend, and then 2007 they did a stock split, or maybe in like the quarter before when I had researched it, but they did a stock split 3 for 2. Basically, they doubled. They basically, if you had 100 dividend payout, if you were receiving $100 in dividend payout, they basically give you more, half of your shares, and it would double. It would half your dividend payout. So instead of 100, you would make $150 in dividend payout. So they did slightly decrease the dividend for the upcoming quarter, but then they bumped it back over their previous quarter and their previous mark. So not really a cut there. They cut it for a very small fraction when they did a stock split, but then bumped it up. So I would consider this a straight through there. Price to book here is 7.58, which is above 3.0, where asset-based companies would be considered a deal. Their price to sales, as I said, services company here, price to sales is 1.59, which is below 3.0, where sales and service-based companies would be considered a deal. So here, dividend yield 1.81, 78 cents per share each year, and payout ratio 52.7%. They've grown their dividend for the past 10 years since 2008, but they've actually grown their dividend for much longer. They had just done a 3 for 2 stock split, cut it for a short time, for a quarter, and then bumped it back over their previous quarter and the previous quarter there. So on average, they increased their dividend there on average 5% per year. So that is all I wanted to cover in today's article. I hope you did enjoy this video and article. If you guys would like to visit my website, check it out. It's over at thefinancial-investor.com. I have the links in the description below. If you guys do want to go over here, punch in your email address here. You guys would then get automatically sent every time I get a new post up on my website. You guys get a notification inside your email that a new post is up and it is available to read. So that is basically all I wanted to cover in today's video. If you guys did enjoy the video, hit that like button. Please share it with your friends on Facebook, on YouTube, on Twitter, social media outlets if they really like dividends. If you haven't got started in your investment journey, if you know somebody else out there that is looking to start investing, Yes, the markets are a bit high. We are going through some volatility, but this is completely normal. If you look back at 2013, 14, 15, those were volatile times, up 4%, down 6%, up 2%, down 4%, 5%. This is normal market times. For the past 3 years where we've gone high, 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 that's not normal. These trending markets is very healthy. It's very, if you're investing the correct way, averaging in as you're dipping down and you're continuing for the long term, next over the 5, 10, 15, 30 years, you're going to be in a better off position than you currently are. So, and that is also here. Quick disclaimer: I am not a financial advisor, tax professional of any sorts. The information provided is my opinion for entertainment and fun. This is me as a financial investor trying to help others make their money work for them. And there it is. If I were to choose one of these stocks here to pick as my random stock here to invest in, I like Hershey's. I don't have that much chocolate. We don't have a lot of chocolate in our house. My kid likes chocolate on, Halloween. But for the most part, I do think that SBSI, it's in the financial sector, which is very funny. But it is looking like a pretty good stock. So if you did like the video, hit that thumbs up button below, and I will catch you later. Have a great day. Bye.